These are very good points. And I think the first key point to understand is that the reason why we are in this situation has essentially been because government have essentially have done what I would call a fiscal whatever it takes to save human lives around COVID. So they've spent between 10 to 15% of GDP, which is massive. This has contributed to one thing, increase significantly the excess savings with households. It has also vaccinated a lot of the zombie companies we were worried about during the negative interest rate era in Europe. And greedflation simply says that when you're put in a position of power, you would abuse your power. And this is very much a human trait. So what companies are realizing is that their ability to raise prices is more important than it has ever been for the past 30 years, simply because inflation is widespread and consumers are expecting higher prices anyway. So what we notice is that with CPI around 9 to 10%, for most businesses, this means through operating leverage, profit margin going higher and earnings per share being pretty significantly higher than they've been since 2007. So we have the Euro stocks 15% above 2019 levels and profit margins at levels we haven't seen since before the great financial crisis. And this is simple math, because 10% increase in prices, input costs typically 2/3 being labor, so it sort of goes up by 5-6%. And then you have operating leverage and you get 15-20% earnings increase. So the reason why we're bearish on equities simply means that governments and particular central banks have no choice but to fight inflation at whatever cost, right? So to conclude, what this means is that we saw what happens when banks lose their credibility. Imagine what it would mean for a central bank to lose its credibility. There's no bailing out a central bank unless you can think about the Fed buying out the ECB. But the key point is that they'll raise interest rate to a level and for a long period of time until the economy slows down. And the issue is that an interest rate hike takes 3 to 5 quarters before hitting the economy. So this is why we think a slowdown is in the cards, and eventually demand destruction will be enough to bring sort of the equity markets to more reasonable levels.
The market only seems to be able to focus on one thing at a time.
Correct.
And the focus at the moment is, phew, we've beaten inflation, all the numbers are rolling over, even in the UK, where core is a little bit stubborn, but the headline numbers rolling over as well. Why shouldn't we be more relaxed about central banks actually beginning to pause and take their foot off the hiking cycle? Because they've won, haven't they?
Actually, no. I think we need to focus not on headline inflation, but core inflation. Because core inflation is what central banks focus on.
Even that's falling outside of the UK.
Well, it's slow. It's falling somewhat, but nowhere near the pace with which it's required. It's a bit like like transitioning to net zero. I mean, it's a lot. I mean, this is obviously greenflation and another debate. But when you look at core inflation and wage pressure, they are not falling nearly as fast as is required. And this, if you look at the latest figures in the US, like the core PCE deflator, it fell by 0.1%, which is not strong enough. So what it means is that you'll have higher interest rates for longer, and I think what makes it even more complex, it's as if, in my opinion, you had companies having developed a natural immunity against interest rates, because you have a stronger balance sheet, you have greedflation that allows them to have decent profit margins, and then you have unemployment that is pretty low. So it's very difficult to see a major slowdown when companies are making reasonable amount of money and you have unemployment at so low levels.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.